Ladies and gentlemen, thank you very much for your time this evening. It's a Thursday, 8 p.m. You know how we usually run these conversations on policy matters, Pacific hours. I know you could be doing something else, so we do not take any of your time for granted. We're here to talk about something pretty important for the next 60 minutes or so, the 2024 Finance Bill. It has a whole draft of proposed changes to our tax code, which for some of us may not necessarily make any sense. We've seen the headlines, right? You wake up one morning and you find out that the finance ministry is saying, you know what, you should actually pay about 16% more for bread. And there's been a massive pushback on that from the government. They're saying, actually, no, we're not trying to tax your bread. But the changes that are being proposed in the finance bill go way beyond that. It's covering everything from making the cost of your daily tipple a little more expensive. It's going to make the cost of transactions that you're making from your bank to your mobile phone, savings, investments in bonds as an individual or for your chama or for your fund manager, if you're putting money into a unit trust, a lot more expensive. It's also going to make Kenya a relatively more expensive destination to put cash into. So we'll explore all of that and plenty more over the next 60 minutes. Stella Soke is a senior research analyst at Standard Investment Bank. She'll be covering the financial side of things with us in a bit more detail. Job Wanjohi is the head of policy research and advocacy at the Kenyan Association of Manufacturers. We've heard over and over the last decade that we want to make Kenya the manufacturing hub of East Africa. And yet, if you look at manufacturing share of GDP over that period of time, it's actually contracted rather than gone up. Why? We'll explore that and plenty more. We also have Zach Munyu, who's the head of public policy at East African Breweries, on this call as well. And there's a million and one things that I'd like to ask you, Zach, but we'll get to all of the fine details around the tax issues in just a moment. But I'd like to start with a general question for all of you, very briefly. What is a one policy change that stands out for you in the 2024 Finance Bill? Stella, let's start with you.
Thank you, Rama. What stands out for me is the taxation on bread, and it stands out for me because it resonates with most or a larger population of the country. And again, it's a basic item. So I don't know whether I should go deep into it or I should just leave it at that.
We can leave it there for the time being because I know we'll come back to it at some point in the
All right.
conversation. Job,
Okay.
what stands out for you from the perspective that you have for the Kenyan Association of Manufacturers? What's the most inimical part of the 2024 Finance Bill?
Eco-levy stands out as one of the most controversial policy positions that the government can come up with, because it is duplicated. We have other policy measures that have been put in place, like now extended producer responsibility, whereby the sales fee is being paid. So we're talking about the role it's supposed to play is devolved, is at the county level instead of at the national level. And sadly, the cost that has been put on it. Sometimes a product that is going at 10,000 is rising up to 20,000, like now a battery. It's one of the policy measures that I feel is very controversial in the Finance Bill 2024.
All right, then, and we'll certainly dive into that in a bit more detail because the Kenyan government has been running around for the last 2 years saying we want to push the green credentials, attract a lot more investment into the green space and green energy efficiency and so on and so forth. But if you're then making green alternatives, low emission alternatives more expensive, face value looks fairly self-defeating. And we'll get to that in a bit more detail. Zach, when it comes to EABL, I know every single year, reporters on my end of the fence, when we look at the budget proposals that come out of Treasury, one of the first things that we tend to know with some certainty, some industries that are going to get hit, is always, quote unquote, the brewers and the cigarette guys, right? So EABL, BAT always get hit. From where you stand, what's the most inimical part of the 2024 Finance Bill?
Thank you, Rama. And I'll start by saying first, I guess those who are expecting or those who stand expecting that cigarettes and alcohol are always hit were disappointed last year because there was no increase on excise for alcohol last year, which was a good thing. And I'll dive into how that translated into additional revenue for government. But coming back to the Finance Bill 2024, I think I'll be selfish and say the thing that stands out for me is the fact that manufacturers, we've now been denied the ability to claim input excise tax. So I'll give the example. We pay excise on ethanol that we use to make spirits like Chrome Gin, Chrome Vodka. Now, one of the proposals in the finance bill is that we are no longer going to be allowed to offset that input excise on the finished good. And I think the biggest impact that we are facing currently, one that is going to destroy local manufacturing of spirits.
Okay, so plenty of things to talk about then with respect to not just how much harder it's going to be to actually just price these products, produce these products, because ultimately these increases in costs, assuming the finance bill passes into law as it is now, will eventually have to be passed on at some some point to the consumer. But Estelle, I want to come back to you on the financial sector, because looking at some of the statements that were put out by the Kenya Bankers Association, Kenya Insurers, I think this is probably, and I might be wrong on this, but this is probably one of the few times that I've seen industry associations coming out very publicly and saying, look, big chunk of the ideas being proposed here are inimical to our industry and consumers because of X, Y, Z. More often than not, these are conversations that tend to be had, shall we say, behind closed doors, right, in committee submissions and so on and so forth. And by the time we get statements like this, it's usually much, much slower down the entire process. But I want to start with something that they said. If we include excise duty, total taxation on financial services could reach 40% from the current levels of 15%, and that will significantly impact affordability and accessibility of financial services. Assuming everything that is in this bill does pass, what does that mean for businesses and individuals in terms of their day-to-day transactions? Can you walk us through that process?
Thank you, Rama. I'll just start by laying out all the specifics of the bill with regards to financial services. So the bill seeks to raise the excise duty charged on money transfer services by bank, money transfer agencies, and other financial service providers or payment service providers licensed under the National Payment System Act of 2011. So it seeks to raise the tax from the current 15% to 20%. The excise duty will also apply to fees charged for money transfers or service by cellular phone service provider and any other fees charged by financial institutions. So the bill goes ahead to propose that it will move various financial services and insurance services from the exemption bit or section of VAT to the 16% standard rate. So in my view, if the proposal is enacted, financial institutions will definitely pass the cost on to the consumers, and this will come in through higher fees. So the catch here is that consumers are already experiencing costly financial services, and they may become less inclined to utilizing these financial services that are being offered by this financial provider. And this again will potentially hinder the financial sector activity. So you notice that the financial sector is a major contributor to the service sector, which again constitutes around 50% of the GDP. I'm trying to explain this to make sure that we all understand the effects or the impact of this particular proposal by the government. So in my view, I feel like the proposal, especially on charging VAT on issuance of credit, because this is one of the exemptions that the government is removing from the financial services, I feel like this will add more constraints to the private sector credit space. Because again, as we stand, the private sector credit space is already grappling with very high cost of credit due to, number one, the tightening of the monetary policy. I'm sure most of us have heard about the central bank rate, which has been increased.
Oh yeah, absolutely. I mean, I got a statement from my bank last week saying raised the base rates by 300 basis points. It's gone from 14% at the bank level. It's gone from 14% to 17%. If I understand you correctly, what you're saying now is that the issuance of credit, my bank is extending a loan to me, that is now going to face 16% VAT.
Exactly, upfront cost. So yeah, that is number one. We have the central bank rate, which is currently at 13%. And these again are levels that we lastly saw around 2011, 2012, thereabout. The number two, we have the aspect of the adoption of the risk-based model, which most of the banks right now have adopted, in that now banks are offering loans to their customers based on the credit score of that particular customer. So if I go to my bank with a poor score, I expect to have a higher rate of lending as opposed to someone who has a better credit score. So those are the two factors that are really my concern with regards to the cost of great credit, which will now be added onto with the introduction of VAT on this particular financial service. So again, it's not a cost only to the consumer of these particular services, but also poses a potential trickle-down effect on the larger economy. And this basically means that the move will stifle financial inclusion. Again, I'm sure that you have heard severally about financial inclusion and this bit on this vision on making sure that people or a larger population is financially included in the aspect of financial services. So again, this particular tax, I feel that it will make services less accessible to a considerable portion of the Kenyan population. And to add on this, the hike in excise duty and introduction of VAT on some of the currently exempt services may again take a hit on profitability of the financial services, especially banks. So I feel like this again will hinder to some extent, the expansion of this particular institution in terms of innovation and even investment in new ventures, because their capacity will have been asked by this particular cost.
Thanks, Stella. And there's something else that I'd like to bring in Zach and Job on, although it's still somewhat related to the questions of which new taxes are applying on financial transactions. Now, one of the things that also did come up and in the finance bill, and KBO pointed this out, was that, look, VAT will also apply on FX transactions, which is somewhat mind-blowing to me, because in some ways you're essentially saying these are companies that essentially you want to grow, you want them to invest. They're going to need some dollars at some point in the open market to be able to import some of the things that they buy. And yet you're going to start imposing VAT on those transactions too. Now, let's assume for the sake of argument that these policies do go into effect. Zach, from your perspective, what does that then do to EABL's FX exposure?
Thank you, Rama. I think the simple answer to it is it renders the business unattainable, because you'll remember our half-year result where we highlighted the fact that we're facing a lot of interest costs, and a lot of them were actually related to borrowing that we were doing to pay taxes. So in the back end of last year, the government moved an amendment to the Excise Duty Act, where we were required to pay excise duty within 24 hours of production of alcohol. So what that meant is, because we haven't collected the money, because we sell to our distributors on credit basis, it means we have to find the money from somewhere to pay our tax obligation. And that now brought us to the point where we had to borrow. And you're borrowing at 19%. The interest rates were crazy. But then at the same time, you find raw materials such as ethanol. Last year, we're facing a shortage within the local space. So we had to source ethanol abroad with contracts that are dollar denominated, which brings in the element of Forex. So in this context where we are saying now Forex transactions will be subject to VAT, and we're already facing external factors which we have no control over, and yet we have control over the amount that we charge in terms of taxes on Forex transactions. I feel like it's discouraging for local manufacturing, and also it's discouraging for sourcing of raw material.
And I remember when that tax measure went through last year, there was the CFO, Rispagenga, had an interview where she said, look, in terms of the cost that this is putting on a business, it's essentially meaning that we essentially now have to go into the market and raise credit lines to the tune of something like at least 1 billion shillings a day or something of that sort. In that sort of context, it just makes manufacturing here completely uncompetitive vis-a-vis just importing the finished product from a completely different market, a distillery or brewer in a different part of the continent.
Absolutely. Currently, if you look at even our neighbors, if, for example, let's take a product like Tusker. Tusker currently goes for 200 shillings at retail if you're going to an affordable bar. A similar product coming from Uganda, you can find it at 120. So the areas around the border, you'll find the product will go for around 120. If you go to the Tanzanian side, it's even cheaper. And that basically the costs that are built into the production that we do in Kenya. And particularly that proposal on the 24 hours. I know currently in the finance bill of 2024, they've proposed to move that 24-hour payment to 5 days. But when you look at that, it's also not going to give us a reprieve, because first of all, the way it's worded, when it says every 5 working days, it means after 7 days we'll review paying taxes every 24 hours. And I'll give the example. Let's say you've sold products today. The expectation is that within 5 days, you'll pay the taxes. We sell products on a daily basis. So tomorrow we'll sell products which we expect will probably be paid 5 days from tomorrow. So at the end of the day, when the 5 days from today end, tomorrow's taxes become payable again and again. And this is a unique proposal because we've not seen it anywhere else in Africa. And the escalating financing costs just making the business unattainable to the point that we are borrowing to pay taxes as opposed to borrowing to invest, which I don't think it's very conducive for businesses that are focusing on growing manufacturing, or a country where we are trying to grow manufacturing.
And this is a country that, if I remember correctly, some of the glass inputs that essentially come in to bottle some of the products that EABL puts out, some of that has to be imported as well, doesn't it? So if you're on one hand, you're getting hit with a higher cost of production, if you're paying for this input in US dollars, those FX transactions are getting hit with 16%. Then you're looking at credit lines through your bank in addition to borrowing at 17 or 19%. Well, the bank then says, oh, by the way, now we also need to apply 16% VAT on this. These are all costs that you simply cannot pass on to the client.
Exactly. Sometimes we have to pass them on because there's a threshold, but we try as much as possible not to pass them on to consumers. And like you correctly put it, for glass, the reason why it necessitates that we import is because we don't have adequate local capacity. If we had adequate local capacity, we would prefer procuring locally because you avoid FX exposures and the delivery is much faster. So the sourcing externally is because we don't have adequate capacity. But if we did, we would actually source locally.
Fair enough. Job, I want to come to you with respect to the question of some of the changes that are being proposed with respect to the manufacturing sector. There's a whole bunch of them that, looking at them in different parts of the bill, it just pops out. 25% excise duty, for example, on vegetable oils. And we import pretty much virtually all the stuff that we consume in this particular market. You spoke about the eco-levy at some point. And I know the argument has been, essentially paraphrasing something from the medium-term revenue strategy, that we need to have taxes in place to sort of account for the negative externalities. Essentially, that economic jargon speak for the negative harm done by the consumption or the use of a specific product. For example, if I go to the petrol station, I top up my car with diesel or petrol to account for the emissions and the damage that will cause later on down the line, we need to have excise duty of rate X in order to account for that negative externality, that unintended consequence down the line. But given all of those issues, is there anything here in this policy, in this finance bill, that is actually of any positive nature for Kenyan manufacturing?
Thank you, Mama Yan. Yes, we have a few examples that we're feeling in the right direction. For instance, though we were asking for abolition of this, what we call the Export Promotion and Investment Levy that had been imposed on metal product at 17.5%, in Finance Act 2023, on cement the same 17.5%, on paper product 10%. And these are raw materials and intermediate products that are not locally available in the country, but you could see they were attracting an export promotion investment levy of 17.5% and 10% respectively. So in the Finance Bill 2024, we have seen the correction of the same. And I've started by saying that we were calling for total exemption or abolition of our exports promotion investment levy, and if it has to be under intermediate products and raw materials, and if it has to be imposed, then it will be imposed on the finished products that we have abundance production in a country. So this has been moved to 10%, but during the public participation window, we're looking at how this can be abolished completely on raw materials and intermediate products.
Let me just interject there briefly, because I remember seeing the brief that you guys had put out. I'm talking about the Kenya Association of Manufacturers. And one of the lines that stood out for me is that you pointed out that because of this export investment promotion levy, the cost of construction has gone up by 40%, which is an incredible number. Can you give us more detail on that?
What is happening is that you have 10% imposition of export promotion investment levy on clinker that is imported for manufacture of cements. And during that period, we saw the cement, and this is ceteris paribus because there could be other factors that are playing, but we saw a bag of 50 kgs cement of the strength of that 2.5 moving from 570 shillings to about 700 plus because of the imposition of this duty. If you're talking about the metal product, the billets, the wire rods, you could see the movement from as low as 800, if you're talking about Y10, Y12, to as high as 1,200 shillings. And this is as a result of us claiming that we have raw material in the country or intermediate product being produced in the country, but as a consequence, it is not being produced, and then this pushes the cost high. When you consider the forces of demand and supply, one thing, the shortage of supply of that product, and secondly, as also Zach has said, there's only this amount of cost that we can produce in your business. The rest you can only pass it over to the consumer. If you're looking at the paper product, again, you could see the position of that 10% and 25% excess duty, again pushed the paper product that are used for the packaging of maize flour, wheat flour, and whatnot. But that's a separate discussion from the food perspective. But because of those two products that had been imposed, EPEL, or Export Promotion Investment Levy, there was that huge diversification in the construction sector. The other thing, and that was not mentioned in that statement, is that we are operating in what is called custom union and a common market, whereby we have 8 to 9 partner states playing within this region, and we trade preferential from one country to the other. In fact, we don't call it export. We call it transfer. So we found that because of imposition of export promotion investment levy on our product that we're importing for value addition, and Tanzania, Uganda, Rwanda, Burundi have not imposed the same, they had a field day in Kenya selling some of these products, cement and metal products, because they're transferring cheaper goods into a country because they have been favored by their domestic taxes.
So if you're a company in this market, therefore, you can essentially play off that regulatory arbitrage and say, look, taxes are going to be higher in Kenya vis-a-vis, say, Rwanda or Uganda as a production base, then I'm going to have easier access into the Kenyan market where people are willing to pay much higher prices anyway. And you essentially have a lot of produce flowing into this market at the expense of Kenyan manufacturers.
Exactly.
Perfect. And we'll come back to that in a moment. But I want to introduce Kigen Kiplimo. He's the head of policy research and advocacy at the Kenya National Chamber of Commerce and Industry. So Kigen, karibu sana. Welcome to the conversation. I wonder from the perspective of the chamber, and I know SMEs are enormous members of the Kenya National Chamber of Commerce and Industry, what are their main concerns with this bill?
A number of concerns from the Chamber of Commerce. MSMEs tend to be the largest part of our membership portfolio. And actually, a number of things that stand out is particularly the e-teams component and the penalty for non-compliance on e-teams up to 2 million Kenya shillings per month, which, to be quite frank, is quite insane. And just to give a bit of context into that, we have KNCCI quarterly business barometer, and this is forward-looking research that measures the expectations of businesses in the coming quarter. And the one that for the issue of Q2, the response that we got, and this survey goes out to businesses, both members and non-members of the chamber, across all sectors, across all sizes, formal and informal sector. And just looking at the response, that more than half of the business that participated in the survey have annual revenue of less than 1 million. So sometimes we do forget that our economy is really micro. We obviously have the big players, but a huge part of it is micro. So if you put 2 million a month, up to 2 million a month penalty on businesses that have an annual revenue less than 1 million in a year, then that is just to say, we should just take this business. For the record, we actually do support e-teams. It is something that we need in our tax regime and will smoothen the collection of taxes and also revenue for the government. But it's the implementation of it. We cannot be in a transition phase and you're putting such a punitive tax. And how this has translated is, you see that for the deadline of March 31st, that KRA had for registration of e-teams, the businesses that they target, they only got 20% of that. So then you ask, if you only got 20% of the businesses that you target, then that tells you that there was obviously a challenge in capacity building, challenge in awareness, because business people are not going to adopt something that they haven't clearly understood. So then what would be your reaction? So is your reaction then to bring a punitive tax that really take out these businesses? No, you have to take a different approach just because of the result you get. And just to give context a little bit more.
So let me just jump in briefly. At what revenue threshold does something like e-teams make sense? And the image I have in mind here, and it's going to be slightly pedestrian, but the image I have in mind here is if I leave the office, say for example, I step out of where Bloomberg is based and I walk down the road and there's a guy who's selling smokies and my basu on the street corner, e-teams for him does not make any sense, right? If I'm jumping on a border to get from work to home, e-teams for that guy and the cost of compliance just does not make sense. So I'm trying to figure out from a policy perspective, is there a point where, even from the chamber's point of view, e-teams make sense if your annual revenue is above?
Yeah. Thank you, Rama, for that question. Allow me to look at it from, yes, there are some categories where obviously it doesn't make sense to have that component just because of how normal operations are done. But the concern here for us is, one, the transition period that was given. Second is the level of capacity building and awareness. We believe that there's still a lot more time to be given for that process before bringing in such a punitive tax. So it is indeed a question of capacity building and being in a transition period, the amount of time that we need to give for businesses to comply.
Indeed. And we'll come back to the question of compliance. And if you're going to impose all these new taxes, and the more complicated the tax code is, you're not making compliance easier, you're making it a lot harder. And that's a lesson that Kenya initially seemed to have learned in the 90s and the early 2000s. But clearly we're back to where we were some
Yeah.
20 or 25 years ago.
Yeah. The way this has affected businesses is one of my members who is in meat and meat products, and they get their products from Kenyan farmers. They're telling me that when eTIMS was brought on board, about 40% of their farmers just said, no, we are not going to supply you guys anymore. We're better off just sending our products to the brokers next door because we don't want to comply or to eTIMS because first we don't understand it. What is it all about? So that is how it's affecting businesses on the ground.
Indeed. And there's a whole conversation, frankly, to be had around this eTIMS business, but we'll probably speak nicely to the guys at Mango and have a separate session on that. Stella, there's a question that's come up in response to the initial tweet. This is from @Baro Isaacs. He's using the handle Bikeman Chronicles. He's asking us to talk a little bit about the motor vehicle circulation tax. And the way I initially looked at this when the bill first came out was I asked myself, okay, let's assume for the sake of argument, just using some of the last insurance premium payments I had to make, which is something in the order of around 70 grand for annual comprehensive cover, which works out to roughly 5.2% of the assessed value of the car. Now, assuming we work with that assessed value and we then take another 2.5% on top of that, essentially my insurance premium would jump from around 70,000 shillings a year to over 105,000 shillings a year. So that's an increase of 40%. Now, you and I both know we can always play around with the numbers, but is this essentially how this is supposed to work? Or am I getting my math a bit wrong here?
Not really. I feel that's how it's supposed to be.
The million-dollar question, I think, that will come up here is we're using this assessed value to determine what that motor vehicle circulation tax number is. But I think the bigger question for me is, are we working with what the assessed value is from the insurance company's perspective? Or is Kerry going to show up at some point and be like, no, we're actually going to work with the CRSP of that vehicle when it was bought, which would artificially increase that number by an even bigger margin?
Well, the proposal or the bill states that or the value will be based on the model, the engine capacity, and also the year of manufacture. And it will also be subject to the commissioner's prescribed guidelines on the valuation of the motor vehicle. So I think the commissioner is supposed to come out after the bill is passed and give the guidelines on how the valuation will be done. So I feel like there's a bit of information that we're still missing with regards to this. For context, the Finance Bill 2024 is proposing the introduction of this motor vehicle tax that we are talking about, and the rate is set at 2.5% of the value of the vehicle, and it goes ahead to set a floor of 5,000 Kenyan shillings and a ceiling of 100,000. So again, it states that this money will be collected by insurance at the point of issuing motor vehicle insurance. And as I've said, the value will be determined based on a number of factors. So the proposal again requires that the tax that is collected, this 2.5%, be remitted to KRA within 5 working days. And I find a punitive catch there that the penalty for failure to account for or to remit this motor vehicle tax will be 50% of the tax due. And this again will be on top of the tax due.
That sort of creates the exact same problem that the firm Zach works for, EABL, is facing, because you're being told, I want the money in 5 days, but that's not necessarily cash that the company may have on hand. Therefore, you're putting them into this exact same situation of having to raise as much credit as they can just to pad their cash flow.
Yes. And again, we've had people or car owners saying that previously they've had arrangements with the insurance companies in that they can be able to pay their motor vehicle insurance for an extended period of time in terms of installments. So there's a bit of controversy there about. So basically, or in general, my view is that if the proposal is enacted, on one hand, of course, it will raise revenues for the government because this again is a form of guaranteed money because people will not stop using their vehicles. But on the other hand, I feel like motor vehicle owners are looking at higher costs, which you've very well explained in terms of what you paid as your insurance and what will be required to pay if this particular proposal is enacted. So we are looking at higher costs of maintaining our cars on the road and not forgetting that now insurers will double up as tax collectors. So there's the issue of administration and also the compliance with the 5 days remittance period. On the higher cost, I say this cognizant of the fact that we are still experiencing elevated fuel prices. And again, an obvious or an unpopular opinion is that our roads are spoiled, most of them. So car owners will again visit their mechanics more frequently than not. And as again, what you've mentioned, insurance premiums are not cheap for most of the people who own cars. And I've had people say that they opt to go for the most basic insurance, which is not the comprehensive, the third-party insurance, just to lower or to cut on costs related to insurance. So again, it's important to note that the motor vehicle tax will not only affect personal vehicles, but it will also affect the public service vehicles that the people who do not have private vehicles use. So again, I look at this as not an issue of discouraging Kenyans from using their personal vehicles, as one of the people who sit in the budgetary committee indicated or cited. So basically, it will have a negative impact on the transport and logistics industry. And sure, these companies or providers will pass on some of the additional costs to their customers. And this again will escalate the cost of living, which the country has been grappling with.
Sorry, I just want to bring that cost question down to the other speakers for a bit. Because if I'm doing the math on my end and I'm looking at a personal level, if I'm looking at a 40% increase in my annual insurance premiums, and I'm one person, I'm a household, I could probably figure out a way of cutting spending in one part of my budget in order to be able to absorb this cost in one big hit and call it a day. Unpleasant, but manageable. But I'm thinking about, for example, EABL's distributors, right? You've got probably 10, 20, 30, maybe 50 lorries, a 40% increase. I'm thinking of companies that might be members of the National Chamber of Commerce and Industries. You've got, say, for example, you're running a retail chain, you're Nivast or Carrefour. In that sort of context, this kind of cost is just essentially untenable. Is this, Zach, Job, and Keegan, is this a policy proposal that, from the perspective of your firms and your associations, you would like to see expunged from the finance bill entirely? Not even a conversation around modifying it, but let's just get rid of it.
Rama, yes. But from our perspective is that there's a very punitive, and I'm looking at from a logistics perspective. I'm looking at what is called the Competitive Industrial Performance Index for United Nations Industrial Development Organization that places Kenya industrial competitiveness at 108th position out of a possible 152 countries that are participating in this. Every day, what we look at is the competitiveness in terms of the in-factory processes, the factory processes, and out-of-factory processes. That is the outbound processes. There is heavy logistics in terms of movement of raw materials and intermediate products through automotive, be it from Mombasa or from ICD to the manufacturing firms, and after that, the distributors of the finished products. If you look at the cost implication, 2.5% of the value of the motor vehicle, you can understand if we pass over that cost to the end consumer, because again, we're going to say what that say, but there's only this much burden that you can show them. Then you can understand how much the end product is going to cost. For instance, we are talking about the transportation of the edible oil. It has been charged 25% at the raw material level, 5% excess duty, the finished oil product level. It really compounds the problem. And that's why we would say that it is not timely to impose this. I like the submission that has been made in terms of the cost of fuel, which is being compounded by now the introduction of this duty on the motor vehicle, whereby the government is taking 45% of the taxes. So it just compounds the situation for Kenyans, makes the cost of living too high. It is likely even to worsen the standards of living because some people can drop even the motor vehicle. And when it is dropped, I'm trying to look at the economic ripple effect. There's a turn boy, there's a driver, there is a mechanic, there is a spare part seller. All these people are going to be affected. So this is likely to shrink the economy. So for us, we are not for this, and it should be reviewed further in the coming year.
Absolutely. Again, I want to come to you on that same question. What does the implication of this look like? Because I'm just looking at a cascading snowball here of one tax after another. You're going to pay more for insurance. You're going to pay more for credits when you go to your bank. If you're moving money from your Pochi la Biashara or Safcom or the Airtel Money or Telcom equivalent into your bank account or in and out of your bank account, that's going to cost you more. At some point, SMEs and even medium-sized enterprises is just going to say, look, it's not worth it doing business in this country. We'll just leave.
Absolutely, Rama. Thank you. So just allow me to mention something quickly on the motor vehicle tax before I talk about the financial services. So my numbers are telling me in the transport sector, it's becoming like airlines where you have razor-thin margins, and particularly how fuel prices have played out in the last couple of years. They're relying on economies of scale. So right now, if you're in the trailer business and you have less than 20 units, then business really makes less and less sense. Now, the challenge here is bankers will tell you that they normally finance premiums for business people and even individuals when taking loans. So then the question here becomes, will bankers be financed taxes for people to be tax compliant in this case? And then the other question arises is there is an ambiguity component this particular proposal. You can go to an insurance company and you can get a monthly cover. And you can also get an annual cover. And the proposal says that the tax is payable at the time of issuance of the policy. So if it's a 1 month policy, so you pay that tax there. Then if you go for the next month, you also pay that tax there. So there's that amount of ambiguity. And that is why we really want this proposal to be struck out. And then lastly, we always have to ask, what problem is this tax coming to solve? So we already have taxes that is paid at the point of acquiring vehicle. You have taxes that is paid with fuel during consumption. You have the road development levy and all that. But what is this coming to solve? Quickly on the question of financial services, one of our biggest challenges with this particular proposal and this finance bill is that it doesn't take in consideration the context that we are in the financial market. We are currently in an environment of a high interest regime. Banks are lending at over 20%. So then do you ask yourself, is this the right time to put VAT on banking services and to increase the excise tax on money transfer for 15 to 20%? Is this the right time to make those changes? Absolutely not. And just to put this into context, if you look at the size of Kenyans, the population of Kenyans that are excluded from financial services, up from 2006, that population was going down, was increasing. But then for the first time, it went up in 2021 from 11% to 11.6%. And according to our projections of the Chamber of Commerce, if this taxes are passed as it is, and we obviously hope that it doesn't, then that population of Kenyans who are excluded from financial services will rise to about 13% by 2027. Finally, Rama, you ask the question that in a time where we have so much diversity of financial services, so much ease of financial services, you can get so many products, so many solutions. Is this the time that we are really going to increase the number of Kenyans who are excluded from financial services?
And that really is $1 million question right there, isn't it? And you've actually raised an interesting tangent, Kigan, because you asked, will bankers actually be lending money to people in order to be able to pay their taxes in advance, which is certainly what's happening now, at least with EABL's case. But let's put aside the multi-billion shilling company that EABL is for the time being. The sector NPLs were around 15.5% in February. We're seeing banks, even with Q1 results that are coming through with NCBA, we've seen it with Equity, we've seen it with KCB. Every single bank is raising provisions left and right. So in that sort of context, given the fact that NPLs are already quite high, we can clearly see, a blind person can see that the cost of doing business, not just in terms of direct costs, but also the administrative burden is going up. Private sector credit is just going to fall off a cliff, isn't it? Sorry, Kiga, that's for you.
Yes, absolutely. And just to put a bit of context to this, there's that proposal of charging VAT banking services, particularly when issuing credit or advance, which is essentially when you take a loan. Then you ask, if I am a bank, wouldn't I be incentivized then to lend more to people who have collateral? So that is more of secured lending than unsecured lending, because in the event of default, and currently it's about 15% of all loans that are issued become bad loans, that at least I'll be able to recover this tax component that had been paid. Then you ask the question, who are the businesses that have collateral? MSMEs, most of them don't have collateral. So then you are excluding them from financial services and access to finance, which is already a challenge in itself.
Yeah, it's absolutely chaotic. Stella, I want to come to you on this question of bonds, because there's also been a proposal baked into the finance bill to do some interesting things with respect to withholding tax on infrastructure bonds, which, by way of clarity for our audience, some of whom may not necessarily be knee deep in capital markets, essentially IFBs were that one little corner of the fixed income market where essentially your gains were largely untapped. This finance bill is proposing different levels of treatment. So I think domestic investors are getting hit at a rate of 5%. Foreign investors are looking at a slightly higher rate as well. Is this going to kill off investments in IFBs, do you think?
Thanks, Rama. It will not entirely kill the interest or the incentive for investors to invest in the bond market, given that the 5% that the bill is proposing to charge on infrastructure bonds for local investors is, again, way less than what we have for the other bonds, the normal bonds, the FXDs. So we have some which have 15% withholding tax, and then we have those that are 10 years and above that have 10% withholding tax. So in my opinion, I think that this particular proposal is aimed at killing two birds with one stone. One is to raise revenues, and number two is to reduce the government's cost of borrowing. So we've recently seen that rates skyrocketed. They've started to come down, and we saw the government paying up to 18% in interest on tax-free bonds. These are the IFBs. Even looking at the budget numbers again, you can see that the interest income on domestic debt carries a higher amount, or the highest amount, as compared to the other payments, including interest on external loans. So I feel like this was one of the goals in terms of reducing the cost of borrowing for the government. And I maintain my first view that I do not think that the tax will push away investors, because again, the proposed 5% rate is still lower than the tax charge on the normal loans.
But Stella, let me
Okay.
just interject briefly. I take your argument that government here might be trying to lower the cost of debt, but short of them actually reducing, meaningfully making actual cuts to public spending, and by extension reducing the size of the deficit, is that really the outcome that's going to happen here? Because everyone who's looking at government spending now, between looking at the budgets, they're saying now they want to essentially reduce the deficit to, I think, 2 to 3%, which would be the lowest we've ever had in quite a long time, probably about a part of 10, 15 years. But there's always this lack of trust around government, because you're at the tail end of the financial year, and then you have supplementary 1 and supplementary 2 comes in with higher spending programmed for random things. So the deputy president's office needs some sort of renovation. State House needs renovations. The rest of us are being told to live within our means. Oh no, but these guys have released that there's money out there somewhere that has to be found. There's a demonstrated track record of a lack of fiscal discipline. And in that kind of context, these budget deficits are likely not to be hit. And therefore, if domestic borrowing levels are still going to be elevated, the cost of debt really won't go down, will it?
No, it won't. And I don't expect it to have a very positive effect or a significant effect with regards to lowering expenditure. Because number one, we have the numbers, and numbers don't lie. We've had the figures for the fiscal year 23-2024, and we've seen revenues lag behind. The course of the ambitious deficit that we have right now for the next fiscal year is because of the ambitious revenue target. And most of us here know that it's pretty much impossible to achieve the kind of revenue targets that we have for the next fiscal year, because given the numbers that we have right now, the best bet is around a collection of around 2.1 trillion. That's the best bet. Then we have a revenue target of around 2.9 trillion for the next fiscal year. And when you look at that number, it's almost a whole trillion that the government is targeting to collect. So I don't know where the government is thinking this money will come from. But to answer your question, I don't think that this will have a significant effect with regards to reducing expenditure, because I feel like we are looking at other methods to reduce our deficit and expenditure as opposed to hitting the nail on the head.
To Stella's point, that the problem in the Kenyan context is not that we have a revenue problem, we have a spending problem, because we're essentially running around and partying as if we are using our dad's Fuliza account and his credit card combined, which is certainly not the case. I want to move the conversation forward, because I've seen some interesting feedback coming through on the tweets that we're having at the moment. Olilai Buta, for example, has said, listening to this space is quite depressing. I agree that the policies that are coming out of Parliament, out of Treasury, are not exactly the sort of thing that will make for an upbeat conversation. But nonetheless, we still have to engage with these policy issues, and we need to figure out what to do between now and the end of June. So that's why I want to end this conversation on. Kegan, from the perspective of the National Chamber of Commerce and Industry, what are your top 3 policy proposals? What are the top 3 things you want to see in the finance bill? And how should citizens and businesses engage to get those outcomes?
Thank you, Rama. We have a number of proposals, and we obviously be submitting this to the National Assembly, the Committee on Finance and Planning. And most of them are mentioned, and some of them, actually, some of my colleagues and have mentioned Kenya Association of Manufacturers and so on and so forth. But just quickly on that conversation of IFBs, as the longest serving independent voice of the private sector, we've had this challenge of the appetite for government paper has been crowding out the private sector when it comes to borrowing from banks. Now, a number of times, Mongo Capital has actually shown us the research and the numbers, and you find that Kenyan banks are one of the largest people who actually take on IFBs. So with this new tax, if there is a way in which we could discourage banks from lending to government and instead lend to MSMEs, or any day, because the comparisons have been that when you lend to government through a tax-free, the return is relatively guaranteed. So if we could have them lend to MSMEs instead, oh yeah, we welcome that any day. I would like to underscore something. The issue of the predictability of our tax rates. So at the Chamber of Commerce, we do a lot of trade missions, both inbound and outbound. And when we do this, we interact with foreign investors. And times without number, we are reminded about the unpredictability of our tax regime, where you could have a new finance bill coming in and significantly affect your business, or even worst case, runs you out of business. If you speak to Zach, the previous finance bill, he's had to contend with a lot because every year there's something new. And investors do make projections. And if you sit in an investment committee, they want to know when they'll do their return and so on and so forth. So as an economy, we are denying ourselves so much FDI. And even locally, some of my members are shying away from making long-term investment, particularly in some areas like manufacturing, betting, and gambling, just because of how the taxation regime has been playing. So we urge the government to have a comprehensive national tax policy that will guide the introduction of new taxes and the amendment of current tax laws, so that we can have that predictability, which will improve investor confidence.
Indeed. Job, from your perspective as a manufacturers association, and I know the finance committee will actually be holding hearings on this finance bill starting from the 28th. So that's next week, Tuesday, all the way through to the 8th of June. That's Saturday, the 8th of June. What are you going to be telling Kuria Kimani and his team?
Well, one thing that we're going to tell the team is that we had a ticket from the government that before the finalization of the finance bill, before we'll have implemented the national taxation policy, because the national taxation policy is looking at various guidelines and various objectives. It's not only a revenue-raising policy document. It is looking at how we can drive exports, because if you're going to drive exports, then you have to look at how you have to be competitive in terms of the quality, in terms of your pricing. But now you see, like now what Zach was saying, that one cannot be able now to claim back the import excess duty on raw materials, as has been the case if at all this is going to pass through. And some of this is used for re-export, or it's used for making finished goods that are made for export. We have to tell them that when you are doing the Finance Bill 2023, you must be mindful of our export base. The other thing is that even if we're in a custom union, ensure that the imposition of taxes must be lower than our peers in the region of the partner states. Because if you impose higher duties, the partner states will continue having free days in Kenya as far as their goods are concerned. The other thing also we're going to tell them is that we want to see predictability of policies. There is one policy that is being changed. This is the import declaration fee. It's changing from 2.5% to 3% in the Finance Bill 2024. If you look back on our IDF, before 2016, it was 2.25. 2016, Finance Act 2016, it came to 2%. By 2019, the finished goods were taken 3.5. The intermediate products that are imported and intermediate products were taking at 1.5. By 2020, another change came into play. 2023, we had flat rate of 2.5% on all the imported products. By 2024, again, we see some change. Why these arbitrary changes every year? So we will go to tell them that we want to see predictability of the taxes that have been put in place, so that our companies can be able to plan their finances and they can be forward-looking, rather than you have your financial plans that are being put up for this year, but they're being disrupted along the way. The other thing also we are going to need to talk about to them is how are we going to help the SMEs? I like what Kian was talking about in terms of the E-teams. E-teams, if you look at the level of subscription, KRA was targeting about 950,000 Kenyans to subscribe to E-teams by March, but only 215,000 had come on board. That means we have 700,000 that are not come on board. But now you see in the Finance Bill 2024, they are saying that if you have not complied with E-teams, then you're going to pay a penalty of 2 million. But this is going to be retrogressive in terms of the SME development in the country, in terms of access now to credit, which has been an issue for them, in terms of access to the market, governance issues. Now, E-teams is going out to compound the problem further. The other area also that we're going to really discuss with them is that as manufacturers, we are interested to source the raw materials locally so that we can do import substitution and we can see the reduction on our import bill on many things. But as we are doing this, let's have the proper governance issues. Let's have tax incentives that are being put along the supply and value chains. You're talking about the farming level. We have the right incentives. And now the finance bill I've seen, unfortunately, it is moving the pest control product from zero rated to VAT exempt, which is going out to make the end consumer's product more expensive. That has been the case. So we are looking at that predictability, that consistency in policy, and the support in backward integration. So those are some of the areas that we're going to look in together with them. And then also the other area is like now on excess duty. We have seen imposition of excess duty light theft center. If you talk about the edible oils, imposition of excess duty, by definition, excess duty is a sin tax. But now we have seen on water, edible oil, you get to the plastics, you get whatnot. So we are going to ask them again that how can we confine ourselves into the basket of ensuring that the excess duty is just being used for the right purpose that it was meant for.
Indeed. Stella, I want to come back to you with a bit of feedback here because there's an interesting counter argument that has come up. Let me see if I can find that tweet. It's from, let's see, Centigai, so CENTI_GUY. And his argument is this, that taxes on IFBs will not reduce investor participation. Uganda, he said, has taxes on all their bonds and they do larger volumes than the NSE secondary market. And the gist of the argument he's making here is that government knows there's no other favorable asset class for conservative local institutional investors, at least for now. And therefore, they have a bit of wiggle room here because they're saying, look, we're the only player in the market here. You're not going to lend into the private sector, credit will take a hit. So you're still going to come back to us, which sounds like a very Thanos thing to say. But do you agree, Salah?
Yes, I do. And I think it agrees or aligns with my point that I don't think the 5% tax on locals reduce the incentive for participating in IFBs.
Indeed. Zach, I want to come to you. EABL straddles a whole bunch of different sectors. You're a manufacturer. You engage with a lot of farmers for some of the raw inputs that you have. I'm thinking, for example, of the sorghum farmers and millet farmers over in Western Kenya. From your perspective, when you eventually do sit down with Kuria Kimani and co. in the finance committee, what's on your wish list? What are you telling?
Thank you, Rama. And I think what you mentioned about sorghum is the best case of higher tax rates do not necessarily yield higher tax revenue. Because when you mention sorghum, for example, we have over 47,000 farmers and they grow sorghum specifically to make one product, which is our product, it's Senator Keg. Since 2004, it has brought a lot of value chain impact. So farmers currently are getting around 2 billion in terms of income. And it's that value chain that never used to exist before. You have trucks that are transporting that grain to our factories, to our malting plants. We use that grain to make Senator Keg, which is sold at a reduced price because it has a tax incentive that is provided by government. And from that tax incentive, so you pay 20% of the full tax that we pay on regular beer that is made from barley. That's income that is going to government that never used to exist before. You have people who are at risk of consuming illicit who have now an alternative product that is affordable, that they can buy and consume responsibly. So if we can have such a thing, and when you look at the finance bill, you will see, and I think it's under section 38 of the finance bill, they've tried to introduce a legal framework to allow such a remission to be put on spirit. And if that actually comes into fruition, what you'll find is that there's a lot more sourcing of ethanol locally. So currently we have 3 distilleries in Kenya. One is probably the one that produces a lot of the ethanol that we use from our local sources, but it's not enough. We have to substitute with imports. Those are jobs that would be giving to the value chain across the sugar value chain, because ethanol is mostly produced from molasses, which is a byproduct or a co-product of production of sugar. So if taxes were a lot more reasonable, so government would meet its objective of collecting taxes. In turn, you'd also create a value chain that creates income that can be taxed as well. Right now, we are talking about ETIMs, and like what Keegan was saying, we are not opposed to such systems because it creates visibility, but we also need to define the threshold from which people need to be taxed. One thing I'd want to touch on, and this is what probably is the biggest priority we have as EABL, is to address the issue of taxation on raw material. Section 14 of the Excise Duty Act has been proposed for deletion within the Finance Bill 2024. Now, that section is the one that allows us to claim back input excise tax on raw materials that we use in our productions. I'll tell you, excise is charged on ethanol that we buy locally or from imported sources where we don't have local capacity. It's charged on sugar. It's charged on glass that we import. And as I mentioned, we prefer procuring everything locally, but even glass, we don't have enough capacity. We have industry demand of around 110 million tons of glass, but the local capacity can only 70 million tons. So that necessitates importation. But the imported glass comes at a 25% excise duty, which is charged on that same product, which will or eventually form part of the cost of goods sold. And there are also other concentrates. So if I pick the example of a spirits product, for example, Chrome vodka currently sells at around 300 shillings in retail. With this new proposal of deleting Section 14, it means the input excise that we have on ethanol. And now remember, there's also another concept which complicates the story, which is we are moving from volume-based excise to the taxing the liters of pure alcohol. So while we were paying 356 shillings per liter before on raw material, in the future we'll be paying 1,600 in terms of excise. And the cost of ethanol there is 170. So we are paying 10 times excise tax on a raw material than its cost. And then the government comes and says that all that cost, which is 1,700 or 1,770, we have to put it in our cost of production. What that means is that chrome that you're getting in the market at 300 shillings will now go up to 770. And that's a 250 ml bottle.
Hang on. If these proposals go into play,
Yeah.
you're telling me that the cost of this product will essentially more than double. That's an increase of roughly, 60, 70%.
100, the price is actually going to be 156% higher than what we are paying today.
But we've seen this playbook before, right? Because there was a time when, I think this was 2013, 2014, taxes on keg, right? Keg beers went up by a significant portion and it practically killed off the entire market. So now essentially you've taken that playbook and we're applying it largely to the remainder of the brewing market.
Exactly. And now it's going to the spirits market. And what we are saying, which is even worse, is imported products will actually be cheaper by around 59%. While a product produced locally like Chrome will be selling at around 770. If I import that same product from Uganda, like we have one of our biggest brand in Uganda because we operate across EAC, is Waraji. If you bring Waraji from Uganda to Kenya, you will land it at 300 shillings. A product produced here is being sold at 770, all because of that deletion on Section 14.
In that kind of context, Zach, and again, sorry, I know I've been told I'm making this space a bit depressing, but given the numbers, right, to quote Stella a little earlier, the numbers don't lie. With those sort of numbers, does it even make sense for EABL to be running brewing operations here or glass production operations here? It sounds like this is basically EABL being told, you know what, it's been real. Luckily, things are not working out. You go to Uganda, go to Rwanda, and then produce there, but then sell into the Kenyan market. At face value, that's what this sounds like.
That's the sad reality because the spirits plant we have here will become unattainable. We are projecting an 80% loss in terms of local manufacturing of spirits. And it would be easier to set up in Uganda and Tanzania and bring it into Kenya, but that's not what we are targeting. And that's why our biggest ask when we sit before Kimani Kuria, this will be the first thing that we'll be talking about. It's double taxation. We've now seen areas of other jurisdictions where they charge excise on raw material and you're not able to offset it. It's considered as a final tax. And it's also encouraging importation, which goes contrary to what we are talking about, growing manufacturing to 20% of GDP. And what we'd be asking for is it's either we retain Section 14 or also remove taxes on raw material. And that's something that we've been discussing. And I remember Job mentioned the national tax policy. This is one of the things that we had proposed in the national tax policy. We are making ourselves uncompetitive in the country the moment we start taxing raw materials, which are supposed to go our inputs towards making a finished good. But when you add that tax, then you become uncompetitive. So that's the biggest ask we have from the government. And it's not all bad, because when you look at last year, we didn't get an excise increase. And that's why I go back to the point that increasing tax rates does not necessarily lead to increased revenue. Previously, beer had been declining at a rate of 2.1% since 2015. Last year, we were able to grow. So the beer volumes, if you check the economic survey, grew by 19%. The reason for that is because there was a deletion, the annual inflation adjustments that used to come every year being executed by the Commissioner General. And also we didn't get any increase through the Finance Act. While if you look at spirits, and that's a case study that they should also look at, spirits revenue actually declined by 0.84%. And the reason for that, even though it didn't get an excise increase last year, the reason for that is that in 2022, there was a 35% increase on spirits. So the industry is still reeling from that huge increase that happened in 2022. And you've seen the levels of illicit, even with the initiatives that are being put in place by Ministry of Interior to crack down on illicit. But the problem will not go, the problem of illicit will not go away just because there are operations being conducted, which sometimes are not even consistent. The problem fundamentally starts with how do we make legitimate products more affordable for consumers?
And if you're not making that product affordable for consumers and legally accessible, of course, you're going to go for the alternative. And just to provide our audience a bit more context on the affordability question. And we've seen this or felt it innately, because when we go to the supermarket and we do our monthly shop, for the sake of argument, we'll get there and monthly shop that used to cost that like 15K, 20,000 shillings, 30 grand, if your budget stretches that far. At that point in time, in 2019, that 15 grand is not going to get you the same amount of goods that it's getting you now. And if you look at the economic survey that was released earlier in the week, this is the first time in, I think, 6 or 7 years that our inflation adjusted wages in the private sector have gone under 700,000 shillings a year. Arguably, that's essentially the cumulative effect of a whole bunch of not just tax policies, but also the inflation that's come through from depreciation of the currency, especially last year. But the bottom line is we're working with an economy that has a lot less spending power. Just out of interest, I'd like to ask a very quick yes or no question to all of our panelists. As far as did Treasury engage with any of your industry bodies beforehand, before the finance bill came out and said, look, we're thinking of doing X, Y, Z. How will this affect you? Zach, was EABL engaged with Treasury at any point? Did they float these ideas your way?
So yes and no. So the proposal to change the excise regime from volume-based to ABV-based, as in moving to a rate based on the liters of pure alcohol, that we were consulted. So there's a project that started last year, and it was a partnership between National Treasury and the Africa Economic Research Consortium. And they were trying to see what is the optimal tax rate, because Professor Ndongo acknowledged that the way alcohol is taxed is not good. And that's why you will see one of the outcomes from the finance bill is effective reduction, slightly reduction on beer tax, because the tax burden, they evaluated, or the workshops evaluated that the tax burden on beer is a lot higher. Now, that same forum is the same forum where we discussed spirits. So spirits, according to them, are paying less tax per liter of pure alcohol compared to beer and wine. And that's why they were proposing an increase.
There was always the possibility that the space would crash, but we're back up and running. Apologies for that. We'll try and get Zach back onto the speaker panel as quickly as we can, and then we can essentially get into the final stretch of the conversation. Job, in the meantime, from KM's perspective, did Treasury give you guys a heads up at any point in time saying, hey, we're thinking of introducing policy X, Y, and Z? Or was this the finance bill and all its proposals, or are they just a complete surprise to you?
Ramayan, I have to state that you were listened to. But when I look at the finance bill 2024, I only feel that we were only heard badly. So you are listened 100%, but it's only partial adoption of what you might have proposed.
It's ceremonial. We did something. We ticked the box and then we say we had.
It's ceremonial because I've tried to look at the sector-based proposals that we had made to the National Treasury, ranging from VAT to excess duty to tax procedure act and all this. You find there is, it was not zero adoption, just Miyaga adoption of what we had presented. And this now is what now becomes a bit disappointing because you're really presenting the issues that members have raised, but you find you are not being heard and adoption is not happening. For instance, we have been making a lot of noise based on the export promotion investment levy, the one that we were discussing before, saying that this is crushing the competitiveness of the manufacturing sector, but still you find instead of abolition of the same, this year they have added other raw materials and intermediate products, though at a lower rate of 3%. But why add? And statistics show that this is not a product that you're protecting in a country because there's no production of the same. Indeed, in Africa, there's no production of under that tariff code. So you find there is a lot of inconsistency. And finance being what I would ask is, let it not serve interests of few people. Let it the interest of the nation, the interest of the citizenry. Let's look at it like what I was talking before, in terms of job growth, in terms of economic growth and development, in terms of export development, in terms of value chains integration. So that once it is developed, it is bringing an ecosystem that is helpful to the government to be able to meet its revenue targets, but also to the citizenry, their interests have been met. So we were heard, we were listened to, but you were partly heard.
Indeed. It's so characteristic of how government engagement has been over the last 10 years, give or take, where public participation tends to be seen as a bit of a box-ticking exercise by those in policymaking spaces. Stella, I know you don't speak for the industry as a whole, but as far as was there any engagement of any sort with stockbrokers, investment bankers in advance to say, hey guys, we'd like to introduce these policies? Stella, are you there? I know you don't speak for the industry as a whole, but was there any engagement prior to the finance bill coming out by Treasury saying, look, we're thinking of doing this and the other. We're thinking of imposing taxes on insurance, the issuance of credit, withholding tax on infrastructure bonds. Was there any engagement as far as you know on that front? Or was the industry just caught off guard by all the proposals that then showed up?
Not me that I know of. And if there was, I do not think that the Finance Bill 2024 really reflects what the people in the industry wanted, because I am sure that everyone, for example, financial industry, are aware of the fact that we have been grappling with the issue of the high cost of borrowing for debtors. And I do not think that anyone would have proposed a charge on VAT on financial services, such as the issuing of credit in the current environment. It may be a good thing in future after we have recovered well, and at least we do not have the kind of monetary policy space that we have right now in terms of the tightening bit. Also, number two, I do not think that anyone would have proposed the issue of increasing the import declaration fee from the current 2.5% to 3%, given that we have grappled with the issue of high fuel prices with regards to the depreciation of the shilling, which had led to a very high cost of importing this particular good. So one of the charges on the fuel prices is the import declaration fee, and I feel like an increase on this would take us back in terms of the strides that we have made with regards to affordable or a bit of cheap imports right now. And even again, just to mention, for almost the whole of 2023, the private sector business environment struggled with a contraction, and two of the sectors that cited tax burdens and higher import costs based on the shilling depreciation and also the taxes that are imposed in the Finance Act 2023 with regards to import were the manufacturing sector and the construction sector. So I feel like if they were heard, that is, if they were consulted, this would not have appeared because it affects that particular sector in a significant way. Thanks, Rama.
Indeed. Zach, I know we got cut off a little earlier when the space crashed, but now you're back. So I want you to finish your submissions and then I'll move to close the conversation for the evening.
Yeah, fantastic. Thank you, Rama. So what I'm saying is there was consultation that was done by National Treasury, and I think specifically for our category, it was unique because we've never had workshops before, but we had that workshop that was talking about finding what is the optimal tax rate for alcohol. So some of the proposals out of the scenario and econometric analysis that was done during those workshops has been actualized. And that's what I was mentioning, that for beer, we've seen a reduction from, if you look at the spectrum of the beers that we manufacture for the industry, it's an effective reduction in terms of the tax rate. But when you look at spirits, it's an increase. And also, I feel like the econometric analysis that was done by National Treasury and the Africa Economic Research Consortium did not consider the fact that we have a very high level of illicit trade in Kenya. Currently, it's at 59%. And I think when they were doing the elasticity, they forgot or probably didn't think that there would be an effect of the increase in taxes, because now what we are looking at is a bigger threat of that 59% illicit going higher, which is bad for the consumers, first of all, because they will be consuming poor quality products. It's bad for revenue. It's bad for manufacturing. And I think what we'd be looking at when we get the opportunity to speak to the Committee on Finance is just highlighting what the outcome was during the consultation with National Treasury and looking towards seeing, even if it's an increase, for example, for spirits, it should be moderate. It's a 70% increase. It's too exorbitant at finished goods level. And also denying the industry the ability to offset input tax is taking that threshold in terms of increase to 156%, which it's unheard of. I don't think there's any country or any manufacturer who will continue being in the country with those kinds of levels of taxes being levied on a product. So we hope the National Assembly will listen to us.
Keegan, let's come to you. The Chamber of Commerce and Industry, were you guys consult at any point in time, or was all of this essentially a surprise for members of the chamber?
Thank you, Rama. So we did take an initiative to engage government on a few areas that we had identified from previous finance bill and also just some chit chat that we had. So we did engage MITI, the Ministry of Trade, as well as Treasury on a number of issues. One being the excise remission period of 24 hours when products leave stockroom. And we submitted to them, like, let's just go back to honor before the 20th day of the succeeding month as we were doing before. But I guess your guess is as good as mine now that we have 5 working days, which is a tricky proposal that is quite inconsequential. We also had some chit chats about around the amendment of the Data Protection Act to exempt KRA from some data protection procedures. And we have raised a lot of concern on this because we are asking what problem are we solving here? The current engagement, the current setup is that if the taxman needs some information from you, they can go get a court order, then they'll be able to be required to give that information. So what is wrong with that current process? And then what precedents will be setting? If we continue allowing some institutions exempting them from these data protection laws, then it beats the purpose of why we had these data protection laws in the first place.
We've been running this conversation for the last 100 minutes or so. And as you can clearly tell from the depth of the conversations that we've had, there's plenty more room and much more nuance and detail that we can get into the weeds. And yes, granted, I fully understand, and I understand why these conversations can leave a lot of us feeling a bit depressed, forlorn, despondent with the way things are working out for our businesses, our careers, and so on and so forth. But here's what we can do. The Finance Committee will be holding its hearings starting from the 28th of May, effectively next week, Tuesday. Now, you can send your submissions to the committee. This is the email address to be using: cna@parliament.go.ke. cna@parliament.go.ke. Now, all the ideas that you have with respect to how the finance bill ought to work, and remember, the finance bill is just one part of public finance. That essentially says we want to raise revenue by changing this part of the tax code. The other end of it is how we're spending the money that we're going to raise, so we're proposing to raise. So if we're essentially saying, look, we want to cut down taxes on X, Y, Z, correspondingly, we also have to make changes on the spending side as well. Send those submissions over to the Finance Committee. The only way in which we'll actually be able to make a difference here is if we as citizens, as businesses, as associations engage with the material before us. It's not going to be pleasant, it's not going to be pretty, but this is the only way to get things done. So I would encourage you, hopefully we're not going to close this on a somber note, I would encourage you to get out there and engage. The finance bill is just the start of this long-running fight that we're all going to be having for the next year or so, but it all starts here. There are things that we know that will not work in this bill. It is up to us to make sure that they do not become law. Thank you very much for your time and your attention in the last 100 minutes. This has been the Thursday edition of the Mongo Spaces. I'm pretty sure we're going to be having memes as usual coming through, plus the usual updates from the team later on in the week. Eric, is there anything else I've left out?
No, not really. I think the key thing is beyond just listening to the conversation, make sure you submit your proposals on the finance bill. You can deliver them to an email that we keep posting on the timeline. So make sure that you do that. I think that's very important to remind everyone. Other than that, we'll have more conversations around the finance bill and all this month going into next week. Sandra, thank you so much. Tell us your perspective on the bill. I know you're the host, so I should push it to you a bit. What's your perspective, if you're to summarize it in a few words, from all the guests that you've hosted and all the conversations we've had so far?
Well, more of us doing the exact same thing over and over again, and the Kenyan government somehow thinking that we can tax our way to prosperity. As Zach pointed out, we've seen a lot of these ideas in principle before, right? 2013, 2014, you try and impose taxes on keg beers, you kill off that market. You essentially have revenue losses, job losses. It's not exactly productive. 2016, you have the rate cap law, which ostensibly was introduced to say, look, we're going to try and essentially cap the cost of credit. Private sector credit did not actually grow as fast as the proponents of that bill had initially thought. And the only effect of the bill was to essentially create this trapped pool of liquidity that happily funded large government deficits to the order of 6, 7, and 8%. And the net effect of that is that if you're holding a certain pool of capital in trust, bank, as a fund manager, your only option is really going to be park money in T-bills and government bonds. And when those are essentially coming up with coupon rates of 16, 17, 18%, why would you lend to someone like me even at 19% or 20%? So it's us doing more of the same. The only difference is that we're doing it in a macroeconomic environment that is extraordinarily difficult. Household incomes have been decimated, in part by inflation, in part by the depreciation of the shilling, and in part by taxes from the 2023 Finance Act. And that data very clearly, and those trends quite clearly in the 2024 Economic Survey, those are very dire numb. And unfortunately, it seems as policymakers and as government, we're simply choosing to not learn from our past mistakes. And it makes me as a citizen and as a journalist deeply concerned.
So I wanted to remind everyone again, not just post stuff on Twitter, but also take those comments. We have a small draft in terms of a Google Sheet that you can put in your comments. In the first column, you just put in the proposal that you're objecting to. The second column, you just put in what your proposal is. And the third column, you just put in your reasoning around it. And then make sure you send those to cna@parliament.go.ke or hand deliver it to the office of the clerk at the first floor main parliament buildings. I think very important to make sure that as many of your proposals come in. It doesn't matter in the past whether we've been listened to or not. Very important that we take it from now here and make this one of the most engaged with finance bills of recent times. So don't forget that. Don't just tweet about it, but also make your proposals heard. Any comment on that, Rama, before we close now?
No. Absolutely. Just the email once again is cna@parliament.go.ke. That's the email address. And citizenship, it's a lot of constant engagement. We've got to get out there, put in the work if we're going to see any change. So that's it from.
All right. Thank you. We're again next week for another discussion.